All right, welcome everyone. Hope everyone is having a great day. We are going to wait just a few minutes to get started here. Let us go live on all the different platforms. We'll put up the comments there so you can drop a comment in the chat as you tune in. And we'll get started here shortly. All right, good morning. People starting to check in there in the chat. Okay, Heather, good morning. Good morning. Jonathan, good morning. So we'll wait a couple minutes here just to get started. Let us go live on all the different platforms and give everybody a chance to jump on. But we got a great topic here today, which we do a lot of and we have a lot of questions about always. So glad that we're going to jump in to this topic here today. All right. Good morning, Paige. Good morning, Adam. Everybody checking in. All right. Okay, I think we are good to go. So let's go ahead and get started here. We'll go ahead and take chat out. So welcome everyone. My name is Kyle Hiersche. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And today we're going to do a deep dive topic into fix and flip loans after we pull up the rate. So Jose, our sales manager with 27 years of experience, is going to pull up some info and go into a deep dive on fix and flips, which we do a lot of here at the Mortgage Calculator. But first, Nick is going to go ahead and pull up our pricing tool so we can go over the actual live rates today of the different programs. So, Nick, why don't we go ahead and pull that up and we'll get into the pricing for today.
All right, let me go ahead and change my screens and we'll get started. So this is our pricing tool for our team of mortgage professionals. If you'd like a full loan estimate, please get with one of our loan officers. We have over 300 loan officers on pretty much every state, and we can do primary second home loans in 22 states we're licensed in. And we can do our DSCR business purpose and fix and flip, which is the topic for today, in pretty much all states for those commercial loans. So this is just going to show our pricing for today. It will show the APRs as well. And today is March 28th, just after 11 a.m. Eastern. So we're just going to check out the pricing indications for today with a couple example scenarios. So we're going to start with a nice easy loan amount of $400,000. We're going to set our LTV to 80. That means 80% loan, 20% down payment. We're going to tell the computer to find the best price at 99. That means one discount point in cost. Most of our customers are asking to buy down the rate a little bit since rates are higher than most people would like right now. That's the typical request. We're going to do our 3 primary home examples here with our conforming conventional loans. Then we'll check out our FHA program rates. And then we'll go into our expanded guidelines, aka non-QM. That's where we can use alternative income and other alternative programs where we have over 5,000 loan programs beyond what you see here. Now, VA is only for our eligible vets. So if you are an eligible vet, please get with us. We'd be happy to quote that. But since not everybody is, we don't do that live. And same with USDA. That's only for properties in a USDA eligible rural area. So if you are shopping in that area, we will be happy to quote it. But let's start with our first scenario, conforming loan. We're going to set everything else up with this same scenario. Purchase, 30-year fix, standard loan, primary home, single family, 1 unit, state of Florida, county of Miami-Dade. That's where our office is. And estimated FICO for all our examples here today will be 760. And our estimated debt to income ratio for all our examples here will be 40. So let's check out our live rates this morning. So pretty much the same as yesterday, a little bit higher. Obviously, we've seen the markets going back up a little bit here, but we have a 6.5 rate for one discount point cost, pretty much the same as it was yesterday. The final APR here in this example is 6.676. So that gives us kind of a baseline. Remember, APR takes all the costs into account. So that's how we can easily compare across programs. So please key in on that. And if for any reason a customer does not qualify for conforming conventional, we'll typically go to the next option here, which will pull up the same exact scenario, and we will check out our FHA rates this morning. We'll keep everything else exactly the same. So let's check out what those rates are this morning. So I believe this is a little higher than yesterday as well. So 5.75% rate for 1 discount point in cost. Oh, actually, this one might be a tad better. 5.75 rate for 0.875 discount points in cost for a final APR of 6.348. So you see that APR a little bit lower than the conventional. Typically in the past that didn't happen, but right now FHA is a very comparable option. Remember, FHA does have upfront mortgage insurance and an annual mortgage insurance. We typically pay monthly. Those have been reduced. So you see these APRs that take all the costs into account do show that in this scenario, FHA may actually be a little cheaper. So please always compare both options for our borrowers. Now we'll go into our final scenario for a primary home. If there's any reason our primary home borrower is not able to qualify with conforming or FHA guidelines for some reason, that's where a lot of other banks or lenders don't have other options. Fortunately, we have over 5,000 other options under expanded guidelines. So when we select this option, we'll keep everything else the same, but you see one new variable pops up here where we can change our income verification. So full doc is what we use for conforming loans and FHA loans. That's 2 years tax returns, what everybody's used to. But typically, if we're selecting a non-QM program, we're going to use one of our alternative income documentation options. So 1-year alt doc, 2-year alt doc have various options. We have asset-related programs. We can use business bank statements. We'll go through our investor programs here in a minute. But our most popular program by far for a non-QM borrower would be a personal bank statement 12-month program. And that's going to be for our self-employed borrowers. Typically, a self-employed borrower, when they use 2 years of tax returns, may have various write-offs and other things that would affect their ability to qualify. So we're simply going to change to a bank statement program. We're going to use 12 months of bank statements to then determine a debt-to-income ratio for this borrower using their bank statements instead of their tax returns. So typically, for most borrowers that are self-employed, this enables us to qualify them where they would not qualify or qualify them for much more income and therefore much higher loan amount for their home of their dreams and to make that option happen. So typically we go to this option when we are running into some limits on the other programs. So we have a ton of options here under non-QM. Let's check out our rates this morning. Non-QM is going to be a little higher rate. So you see the rates here in the 7s instead of the 6s and 5s. But remember, we always compare our APR. So our first option here, 7.375 rate for a very reasonable 0.625 discount points and costs, give us a final APR of 7.410. So when we compare that, it's a little bit higher than conventional and a little bit higher than FHA. But remember, this is for a borrower who would either not qualify at all or needed to use alternative income to qualify for more income and therefore more loan amount. So these are great tools for us. If you are in the market, we definitely recommend to compare all of these different options. Now let's go back to our pricer and do our investment property scenarios. So those were our primary examples. Now for our borrowers that are looking for an investment property, we love to look for our investors, whether it's your first investment or you own 100 plus investment properties, we love to provide options. So if we switch this to investment, put the same LTV, 80% loan amount and 20% down payment, keep everything else the same, we're going to compare our conforming conventional investment properties programs with our non-QM programs. Remember, FHA, VA, and USDA are not eligible for investments, so we're simply going to compare these two options. So we'll start with our conventional, keep purchase, 30-year fixed, everything else the same, and let's see our investment property rates this morning. Now, keep in mind here that the GSEs for the conventional loan programs have added loan level price adjustments for investment properties. So while we have very reasonable rate here of 6.875, the discount points are very high because there are price adjustments here. So unfortunately, the computer did not find a 1 discount point option. The best combo here for the lowest APR was a 3.5 discount points, which is in this example $14,000, which is a lot of money out of pocket for our investors. So we would love to present this option, which is a very reasonable APR, 7.135. However, many times our investors would like to raise the rate or okay with going higher in the rate because their property's cash flow and they want to save money out of pocket. They'd rather deploy this $14,000 towards another investment. So there's are a few options here to go up in rate. You see here 7.125, a little bit lower discount points, but none that fall into the 1 discount point option. So that's where we love to present our non-QM options. So let's go into our final example today. Set the 80% loan to value, set investment property, and we will set our expanded guidelines, aka non-QM here. And for investment properties, we have 2 new variables that pop up. So first, we will select our income verification. The most popular income verification method for investment properties by far is going to be our DSCR options. And that's because it does not require any income or employment from the borrower. We're simply going to use the estimated rental income from the property in order to offset the mortgage payment, the PITIA of that mortgage. If the rental income can cover the expenses, the PITIA of that mortgage, that's a DSCR ratio of greater than 1. And we have a ton of loan programs at greater than 1 ratio. We even have programs for under 1 ratio, aka a property that doesn't quite cash flow enough to cover that payment. We can still offer programs for that. So we have hundreds of programs under this DSCR umbrella. Please get with our team so they can find the one that fits best for you. Now, our final option we have to set here is our prepayment penalty. That is a standard feature for a non-owner occupied property under non-QM. So we will typically price this with 3 years as standard. We can select 0. That is an option, but that will limit the number of loan programs available and it will cost more. And we can also select 5 years, which will also limit the amount of loan programs, but save us a little bit of money. So the most common option is 3 years, and that's what we'll select for our demo here today. So let's check out our DSCR rates this morning. So here's some very reasonable options. We love when the DSCR rates are very comparable to the conventional here. So obviously DSCR, no income, non-QM program are going to be higher rates, but very, very comparable right here. 7.875 rate for 0.85 in discount points. So our investors saving that cash, and a very reasonable APR of 7.917. So a little bit higher APR, obviously a little bit more expensive product, but remember, no income, no employment needed. So our borrowers that own multiple rental properties often will cash out a couple rental properties in order to purchase more rental properties. So we can start 2, 3, 5, 10 of these loans at the same time for our borrowers that have multiple properties. So a lot of advantages here to the DSCR program beyond just the ability to get a reasonable discount point cost. Now, if you see here, there's tons of different options here with different DSCR amounts. So please get with our team to find the one that fits best for you. There are hundreds of programs here under DSCR. Some of these may allow things at the higher rate amounts, such as short-term rental income. So a lot of different flavors of this program. Please get with our team, and we're happy to find the one that fits best for you. So let me switch my screen here, and we'll get into our live example today. Give me 1 second. And I'll introduce our topic. So for those of you who weren't here at the start, our topic for today is going to be our fix and flip loan program. So we don't have a live pricer for those. Those take a little bit of work. So Jose has been behind the scenes. Our sales manager, Jose Gonzalez, was putting together some quotes for us from our fix and flip options. These do vary very much by program and by the property, right? So these are very specific to the quote. It's very hard to do a general quote for these. So in these examples, Jose is going to have a very specific setup of a property price, rehab amount, etc. So please get with our team if you have a scenario. Every scenario is different on these fix and flips, but we'd love to quote these for you. It just takes a little bit of time because we don't have that instant pricing button. So let me go ahead and introduce Jose and let you take it over there, sir. You ready?
Yes, sir. Good morning, everybody. Thank you for joining us for Daily Mortgage Rates Live with the Mortgage Calculator. Fix and flip loans are very interesting, very popular. If you're not into fix and flip loans as an MLO or as a borrower, you are leaving money on the table. at the mortgage calculator, I would say at least 15-20% of what we're doing right now coming in fixed flip loans. Very interesting because it does take a different mindset when you're doing a fixed flip loan, because it does not use any income from the borrower, right? So forget about if your borrower is making $1 million a year. What is really important here in the fixed flip loans is the profit on the deal and the experience level of the borrower. And obviously, credit as well. We're not going to discount credit here because it is essential, but it is all about the profit on the deal and the experience on the borrower. A higher profit margin on a deal will get the borrower more favorable terms. A higher experience level of the borrower will also get the borrower more favorable terms. And the opposite is true. If you have less experience or if there's less profit in the deal, you will get lower loan to values, or possibly the deal will be rejected. The rationale is that if your deal has a higher profit margin, it is more likely to be successfully completed. The whole flip, from the purchase of the flip to the renovation of the flip to the sale of the flip, or the refinance of the flip into an end loan if the investor is going to keep the property. And with that very important point being said, it is critical for the loan consultant to assist the borrower with their exit strategy, right? You just can't mindlessly go into a flip and wing it and not know what's the exit strategy. Are you going to sell the property? Are you going to keep the property? If you're going to sell it, are you over improving the property? Is there actually market value there for you to deal with successfully after closing? What is the rental rate on the property? Is it going to cover the necessary expenses if it's a DSCR loan? Or obviously, if it's a full doc loan, other considerations there. But there needs to be an exit strategy, either flip it to sell it or hold it to rent it. Right. So, with that being said, putting context into the situation, I'm going to share.
Before you go to the example, Jose, can we touch on the experience? Because I don't want people to get blinded by the numbers.
Oh, yes.
What does experience for a borrower mean before we go into the numbers and people start looking at numbers?
True. Well, then let me expand on that and give a little bit more context. Thank you, Nick. Yes. Experience is experience with the flip, right? With the actual ownership of the flip and the management of the flip and the risk involved with the flip, which means you have to be on title on that transaction when it was purchased, when it was managed, and when it was sold, as the owner of the flip, not as the contractor building the home, for example, because many times we do get requests where now the builder that was building or renovating all these flips for the actual flip owner now says, sure, you know what, I'm doing it for these people, I'm going to do it for myself. And then they say, yeah, I got 15 flips in the last 3 years. But what they really did is they built 15 homes or renovated the flip for the owner of the flip, but didn't actually participate as an owner of the flip, didn't incur any risk with the purchasing, with the managing, and the risk involved with holding it while you're selling it. To successfully complete a flip shows a lot of responsibility. So you actually have to be an owner of that flip on paper. In other words, your name has to appear, or your entity name, or an entity on which you are an owner or a member of, has to appear on the purchase of the flip, and then also has to appear on the sale of the flip to have that full cycle completed, the flip cycle. If you weren't involved in the purchase of the flip and in the sale of the flip, then you're not an owner in that flip, and you cannot put that flip into your track record. So it's really important you differentiate between a contractor who's renovated properties and the investor who's actually participated in the flip and held that risk for the 12 or 18 months, whatever time, and successfully flipped the property. So
So the one experience means buy, renovate, and sell. That counts as one, correct? When we're talking
Correct.
about experience. Okay.
Correct.
Just want to make sure everybody's on the same page here.
Right. Buy, renovate, sell, or buy, renovate, keep. Either or, the renovation process, the whole cycle has to be complete, and you have to have exited successfully from the flip, either through a sale, which made money, by the way. You just can't sell it and lose money, because then that was not a successful flip, you know? So you either have to have that successful flip or successfully flip it into a profitable rental property, right? They don't want unsuccessful flips as track record. That's really important there.
Okay. Well, let's get into the numbers then here.
Yes, sir. So now what I've done in my examples here, I have 3 for us. 2 are going to be from the purchase, and 1 is going to be for a refi. And so what I've done on the purchases, I'm doing one where the investor has 5 flips, which is this investor, 5 flips in the last 3 years, and the next one they have 1 flip. This is an actual scenario that went through here. A very successful scenario. So this purchase price is $400,000, rehab budget of $100,000, and an after repaired value of $700,000. In this particular case, the borrower qualifies, because of the high ARV, qualifies for a $440,000 loan amount, right? And the estimated liquidity requirements are down payment and closing costs of $77,990, a liquidity buffer of $6,600, the debt service on that loan of $36,112, for a total outlay of $120,702 for the borrower to cover all of that stuff. So in this example here we're going to get into the actual flip side here. We have total costs of $501,645 with a gross profit of $198,355. And now, due to the great numbers that this flip has, I mean, it's not every day you're going to get a flip with so much meat on the bones, but here you get really low rate. They love the deal, right? 110% is what he's borrowing of the actual of what we were putting the as-is value, which is amazing. As-is value of $400, purchase price of $400, and we get a $440,000 loan. So you see there the numbers right there. So the ARV loan to value 62.82. So that's very phenomenal. So in this example, they're I mean, you know, maximum there. Look at that loan to cost, right? So obviously that's with 5 flips. Now it's the same scenario here. Now I have an experienced borrower with 1 flip in the last 3 years. So again, still due to the good ARV, we're still getting good numbers here, but you'll note that the total loan amount went down by $20,000. That really wasn't much. In this case, they're getting up to 80%. So we look at the numbers down here. Same cost, same profit. The only thing that has changed is because of my investor's experience, he got a little bit less money. So we have here 83.72, 60%. So, you know, phenomenal when you can get a flip like this, right? I mean, he's borrowing all the money for the deal. Now, let's look at the experienced. Well, I'm saying all the money for the deal as in the purchase, the initial purchase. Now, this is something a little bit different. This is actual request that I received the other day from one of the teams saying they had a borrower that has a property free and clear, right? He bought it for cash for $200,000, and now he needed $100,000 to do repairs on his free and clear property. He just bought cash. A lot of these properties in the lower price ranges, they buy them without financing. Maybe they're using another line of credit, but the subject property is not encumbered with any lien. So in this kind of a scenario here, obviously they're going to lend us the full money. They're lending us the whole $200,000. Our ARV LTV is 44.44, and our loan to cost 66.30. But essentially, obviously, he only needs 100. He wants 200. So he's, borrowing 100% of the rehab because the property has equity. Same concept there. If the equity's good, you're not going to have any issues. They're going to lend him the full $200,000. He'll use whatever he needs, and the terms, the costs we had here. Excuse me, I wrote them up in the top here. Yeah. So total that the borrower would need, including, this is collected at closing, the 12 months upfront debt service, the liquidity buffer of $3,000, closing costs of $94.90. So there's $39,725 that will be deducted from the $200,000. Still cashless transaction now. So and $100,000 is going to be the rehab budget. So the borrower is still going to have roughly $60,275, I think is the math, more or less, cash out plus the rehab money. So win-win situation. That extra cash out money, I think that's probably going to go to another purchase, right? They're going to keep flipping that money and making that money grow as long as they can do it, as long as they can find the deals out there. Why wouldn't they do it? Get all your money back and get more money to buy another one and start doing it again. Really good option. So again, I'll show you the numbers here. Really good options there. So there's no profit margin on this one because it's a refi, but still 11.49% interest only, and it's paid up front. So in essence, you do not have any out-of-pocket payments throughout the time that you're doing the flip, which takes away a little bit of pressure.
All right, we got a couple questions we should probably bring up here, Jose. So, first one, Christina's asking, do we need a credit score? What were your credit scores in those examples? I don't know if you went
740. So yeah, you do need credit. That's, I think, one of the first things I said. You need some meat on the bones there, the profit margin. You need experience, and you do need credit. I mean, this is not a no credit program at all.
What do we have as low as 600?
Yes,
I believe is the lowest options we have for fixed flip.
I mean, obviously, like anything else, it is risk based. So if you do have the lower credit, it will affect the rate a little bit. Loan to cost probably a little bit, but it's still doable. Even with no experience, it's still doable.
And does this mean that's a non-recourse loan then, or is it not because it involves credit?
That is a specific question that we would have to reach out to each of our conduits to find out if they are non-recourse. They are. They do require closing in an entity, though, so there is no personal name closing in these loans.
All right, here's a question from Taryn. What constitutes a successful retain for, I'm guessing, fix and hold she's referring to. So how do you prove a successful fix and hold?
You refinanced out of the flip loan before it expired,
Well, and the appraisal is greater than what it was before, right? So the success would be you bought it for 100, you put 100 into it, and then you got an appraisal for 400, and you got cash out of it, right? So the 400 is the success, right? Yeah. There is a bar for success, and it's that it appraises for more than you put into it, right? We need profit. Right.
Now, one of the things to consider also is the market rent, right? Because if all of a sudden you're thinking you're going to do a DSCR and then the market rent comes up lower and then you can't do it because of whatever constraints you have, that is your forecast of the market rent is almost as important as the valuation.
Okay, and then one more question here from Saba. I think a lot of people are confused on the refinance. Can you just gloss over top level on what that example that you were going over? I think
The last one is
Yeah.
a cash out refinance of a rehab property where the borrower bought it without financing
maybe at an
or
auction with
yeah,
cash or something
yeah.
like that, right?
I mean, a lot of these investors do have lines of credits set up so they can buy a property cash, so to speak, without encumbering the subject property, right? So, but in this case, this was a cash out refi. The subject property did not have a loan against it, or even if it did have a loan against it, as long as you're getting more than what you owe, that's a cash out refinance. And in this case, it's just happens to be a rehab loan. So, we just examined the same parameters of there having to be equity.
I guess for those of you that are loan officers and a little more familiar, when we talk about fix and flip, that means bridge, aka a short-term loan with rehab, right? There's bridge with no rehab. If this customer in this case just wanted their money back that they paid cash at auction, as long as we can get an appraised value, we could get a bridge loan for that. But the most common request is someone buys, like Jose said, cash, needs some rehab. Then we do a bridge cash out with rehab, right? So a bridge loan could be a purchase loan or a refi, just like any loan, and it can have rehab or not rehab. So it's really an option for any of these, right? So no matter how the borrower purchased it or is going to purchase it, we can always do a bridge with rehab or even a bridge with no rehab in these cases where maybe the borrower wants to pay for the rehab out of pocket, but they want to get their money back from their investment. So, and Jose could have done a bridge with no rehab and probably got a little bit lower interest rate on that exact example because he could have just used the cash out. If he just gets 100,000 cash out, he can use that for whatever he wants. You don't have to have a rehab budget in the loan. So, bridge with rehab, bridge without rehab for properties that are, I guess, what would you say? Not otherwise financeable, right?
Condition challenged properties. I mean, the main thing to note about this program is that it is specifically for properties that, due to condition issues, cannot be financed through regular channels because there could be disassembled. They could have, full of holes in the walls. That's the usual scenario. Is you have a non-compliant property, maybe code violation stuff that liens could even have it, stuff that could cause it not to be financeable under normal channels. And then the only option may be this type of loan if it's an investment property, or not part of this show today. It's one of the ones coming up in the next couple of days. Or if it's a primary or second home, would be a one-time close or a renovation loan. What, like the 203K or the conventional renovation loan that allows you to close with those property condition issues and take care of them as part of the loan.
Exactly. All right. Well, I think that's it for questions. So you want to wrap it up, Carl?
Yeah, perfect. Thank you. So as Jose was talking about these different options, remember, we have loan officers that are consultants that can walk you through these different programs. So lots of different ways, as Nick was saying, to get a bridge loan, and it can be done in many ways, but to accomplish different goals, right? So our loan officer consultants can walk you through how to reach your goals that you're looking to do here. So to connect with one of our loan officers, you can go to themortgagecalculator.com and we can pair you up with one of our loan officer consultants, or you can email us info@themortgagecalculator.com. We have over 300 loan officers all across the country, licensed in 22 states for primary residences, but most of these fix and flip loans we can do in almost any state. So we do this show at 11 a.m. Eastern every morning, every weekday, so you can see how the rates go up and down. And then we do a deep dive every single day into a topic, just like we did today with fix and flip loans. So appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. And we hope to see everyone tomorrow at 11 a.m. Eastern again. Everybody take care. Have a good day.
Thanks, everybody.
Thank you, everybody.